I think being a founder is a constant game of keeping up with the pace of your company's growth, and that you need to scale yourself as well. I think one of the first things I look for is that they have extreme learning slope. Another thing I look for is that they're influential communicators. They can go broad, they can go wide, they have range, they're clairvoyant communicators. Start doing the job you want to have.
Before we begin, remember, the views expressed on this podcast are for informational purposes only and not financial or legal advice. Consult with a professional for your specific situations, and the views expressed are my own and do not necessarily reflect the views of Finalis Inc. or Finalis Securities LLC, member FINRA SIPC. And with that, Mercedes, welcome to the Silicon Valley Podcast.
Thank you for having me.
Now, you've written extensively on your blog. Can you share your thinking behind concepts like the hierarchy of metrics and why founders should care?
I have been writing on my blog for 11 to 12 years now. And I think that I write a lot because after I became a VC 6 years ago, I wanted to help founders see around corners. I think one of the most important things you can do as a founder is understand what type of leader your company needs for this phase of the business, and then to go embody it. It's very difficult for founders, and I see this with the unicorn founders that I work with, because you're constantly having to understand what's around the corner, what's ahead of you when you've never been there before. And so my blog is really trying to break down a lot of the insider baseball secret knowledge that I've learned from being on the board of unicorns, and helping distill that into frameworks that founders can understand and implement so that they can actually see around the corner and grow into the type of leader that they need to be. I think being a founder is a constant game of keeping up with the pace of your company's growth, and that you need to scale yourself as well. So for example, the hierarchy of metrics, that came about from a board chat conversation that I had for a unicorn company with some of my fellow board members, where we were trying to give the founders feedback on what do they need to prioritize most. There's so many competing factors for their attention. And we ultimately aligned on orienting them on customer love, engagement, and retention as the North Star metrics, as more input metrics, whereas there's a lot of output metrics like financials and unit economics that they could focus on. And so for me, it's, that's the type of thing you're never going to get access to, is understanding what actually happened in the group chat of a board of a unicorn company. And so I asked the founders and my board members if it was okay to share. And they said, yeah, as long as it's anonymous. And so that's kind of what I did.
What are some of the takeaways from that talk with the board? And also, I've never heard of input versus output parametric or metrics. Can you talk a little bit more about that?
Yeah, sure. So input versus output metrics, I think of it's leading indicators versus lagging indicators is another way to think of it. What are the levers you can pull in your business today that have a short-term effect that will downstream affect other metrics and other outputs? And so when I say that engagement and customer love are leading indicators, what I mean is, if you think about the user journey, when someone first comes to your product, immediately they need to decide if this is a magical experience, if they love or not. First, there's a hook and there's something that activates them. Then they have a magic moment. And then they go, okay, this is a magical product that I'm going to continue using. And then they start using it a lot. You get high engagement in that first few days and weeks of a product's usage. That really predicts a lot about your long-term output in terms of what that user is going to contribute. They probably are going to be a higher revenue generating user, which is and a more retentive user. And those things all go together. And so the input metrics are, do they love the product? Do they engage in it a lot? The output metrics are, what does that do in terms of resulting in financial metrics? Your LTV CAC, your P&L of your company. Those are kind of lagging snapshots of what already happened in your business. And so if you try to optimize everything around just the financials, you're always going to be working on data that's a little bit behind the curve of where you could really put your finger down on the scale if you wanted to affect the initial way users use your product that will later affect the financial outcomes.
For figuring out the input metrics, is that more the CFO's role, the CEO's role? Who should be the one thinking about the lead-in indicators versus kind of summarizing the lagging indicators?
Highly strategic, and it's something that the entire C-suite needs alignment on. But really, the conversation needs to be driven by the founders and the CEO, and the rest of the team all has responsibility in making sure it is measurable and actionable, and that you actually have the data to be able to, when I say measurable, you have the data to be able to measure it, and actionable meaning you have the levers and the product and the operational setup to actually change where you put the emphasis of investment and time by your team members to affect those things. But really, it needs to be strategic across the whole C-suite.
For the board itself of a unicorn company, how does the board celebrate big wins? Because I would think that as the company would grow, the board would go, yeah, we were a huge part of that, pat themselves on the back and smile and give each other high fives all the time. I would think it'd be very competitive to be and stay on that board, but yet super rewarding.
Well, I think as an investor, if you're patting yourself on the back for a company's outcome, then you probably, unless you're a private equity investor where you own and you're majority control, as a minority stake in, venture capital investor, I think you're probably a little bit mistaken as to how much you did versus others. My mentor, Jeremy Liu, who was the famous investor who did the investments in Snapchat and Affirm, he used to say that there's 30% of the success of a company is maybe due to the investors, maybe 3%, somewhere like that. About 100% is due to the team and the people that actually worked there and built it. And 300% of the success is owed to the founders and the people who started the company, because they had to literally give up everything in order to make it a success. Without their over 100% investment, it wouldn't exist today. And so I like to think of it in that order, that we were the smallest part of it. But in terms of your question of, how do we celebrate the success of our companies? I think one of the big jobs of investors is to keep founders grounded, make sure that the highs aren't too high, the lows aren't too low. Speaking of my blog, I have another blog post on the 9 roles that investors can play for their startups. I had actually put it on my LinkedIn a few days ago as a new LinkedIn post. And I think there's kind of these classic 9 archetypes that we fit into and the roles we play. And one of them is that steady rock who helps the founder kind of navigate the highs and lows so that you never get too upset about any one thing.
Are there any other than 9, maybe 1 or 2 more that you could share with us?
One that someone suggested on my LinkedIn post that I thought was a really good one was because I had ones like the super connector, the steady rock, the exit navigator, the insights analyst, the specialist, the industry vet. One that someone else suggested was the aligner, the person who actually does the job of making sure everybody's on the same page, because you can really have gridlock on boards and with companies and leadership if everyone can't agree. And the diplomacy skill of being able to smooth things over, reframe positions, make everyone see where each other's coming from and coalesce together, that's a huge skill.
Now, is that skill more for the C-suite or someone on the board, or is that, where would that skill set be ideal to get companies moving, to get companies aligned?
I think you need it in both places. For the board, you need someone like that who's going to help the board get unstuck and also make sure it's not a board where there's no real investment from the board members. People aren't checked out. On the C-suite and on the leadership team, you also need this. A lot of times I'm working with very young startups. They're not always at this late stage. And at the early stage startups, this looks a lot like the people who are kind of constantly iterating and asking the question of what's our number one priority? What we have too many things to do right now. What should we be working on right now? And so sometimes it takes that form from early leaders.
Now, a new thing that you're working on, when a partner at a fund begins preparing to raise their own fund, what does that process look like both logistically and emotionally?
Oh, that's a great question. Um, yeah, I think for myself, emotionally, I think one of the hardest things I had to do was convince myself the risk was worth taking.
Well,
One
right
thing
there, what's the risk? I'm just kind of
what's the
curious.
risk of starting something new? Well, the risk is that you are unsuccessful and you fail, and that your new thing doesn't get off the ground. Um, but I've come to believe that you achieve the size of your ambitions. And, I used to think like, I even hate to say the word manifest. I thought it was total woo woo. But there's a lot about brain chemistry and science and around setting intentions and being able to achieve what you set out to do. I think one of the big things I debated with myself and ultimately convinced myself of is that, look, this was the job I wanted for the rest of my life for the next 30 years. And so different things like it's a terrible, environment for fundraising, or it's not the right time right now, are really became kind of more minuscule factors when you're playing on and planning on such a long time scale. One of the two ways I thought about risk was one in poker. I think one of the things I've learned a lot from poker is that you play the hand you're dealt. I actually, when I was learning how to play, used to try a lot of different strategies. And one of the strategies I used to do was only play my hand if I had an amazing hand. Like if I had double king or double ace or king ace. And then I realized actually you lose a lot of money that way if you only wait until everything is lined up. Instead, you got to play whatever hand you're dealt. Now, not whatever. Sometimes you get a 2-7. That's the worst hand in poker, by the way. You might just want to fold. That's okay. But, if you get a double eight or if you get a 7-9 offsuit, on suit, it's still something you can win. And I learned it was a lot more about figuring out with each turn of the flop and when the river and turn came together, if you really were how you judged the value of that moment right then. It was a constant iteration on what is the best choice right now, not what is the optimal best out like potential position I could ever have. That's not the right way to think. And so once I reframed that, it became so much easier to think about, oh, okay, sure. Like I can do this. Of course I can. It's just going to mean every day in and out as I'm building this, I have to ruthlessly prioritize for what's the best thing I should be doing right now and play the best hand I have. And I will get very far doing that.
So for our listeners, there was Texas Hold'em that Mercedes was talking about. I am curious correlations between VC and poker, Texas Hold'em. Do you find that a lot of the best VCs are habitual card players on the side there?
Oh, 100%. I think half of Silicon Valley is obsessed with poker in some way or another, but it is especially a VC thing.
Why is that?
It's because it teaches you to think in expected bets. You are dealing with imperfect information constantly in poker. Poker is not like chess. This was actually a big thing I thought a lot about and how I changed the way I approach making big decisions is chess. And Annie Duke has a great book on this, which is where I'm borrowing this concept from. She's the grandmaster. Sorry, I would say grandmaster. She's one of the top poker players. And she said that in chess, all of the options are known. Everything's out there on the board. You can, if you really were able to compute mathematically with your brain every single step, you could see it right in front of you. With poker, that's not exactly the case. Yes, you can do a lot of counting and calculations in your head, but you really don't know what order things are in and when they're coming next. And so there's a great deal of variability. And that is what we have to do all day long as VCs is when we're presented with a new investment, we have to make a decision in a relatively short amount of time based on imperfect information. And I had previously been a bit more of a chess thinker. I wrote a post almost 10 years ago called How I Make Big Life Decisions. And it was ranking every single option I had in a decision matrix, scoring them, weighting what were the different variables and factors I cared about, and then kind of coming to an output. I really used it more as a tool to figure out what I cared most about, to kind of like gut check, like, did that number feel like the right answer? But it was more trying to boil the ocean and figure out every single possible path. Whereas I think now what I think about is what is my best option on the table today, and then play it accordingly that way.
Speaking about best option today, how do VCs go about, say they have a new fund, they have, or they will have a new fund. How do they manage their current portfolio and a new portfolio simultaneously? How would they allocate time? How would they go about doing that?
I think I'm just all in on both. I don't think there's an option to not serve your portfolio companies in the best way possible. That said, you do work on a transition plan in terms of making sure that your companies have a home, they have a partner. But, being frank, it's difficult when the person who originally made the investment is not the one who's still there. Companies do get orphaned a bit. And I do think this is part of what you're seeing a little bit in venture is there's a lot of movement and people moving firm to firm, place to place. And really the only way to be totally secure with your partner is if they're probably the founder of their firm is the only way you'll know they'll be there forever. But look, at the same time, that said, I do think it's just something that people will probably need to accept as kind of the fact of working with people in venture.
That's a good question, right there. How would a founder, is there any questions that they could ask while interviewing funds that might be interested in investing to find out, is this person in front of me going to be the one that I'm working with? How could they go about at least planning out maybe the interactions in the near future? Any suggestions on that?
Well, in the near future, it's relatively straightforward. It's going to be the person that you sign up to work with. But I do think it is important for founders to know that you always have a choice of who you work with at the venture firm. People get different types of credit for a deal coming in. Sometimes it's a sourcing credit. Sometimes it's a board credit. Sometimes it's working on the deal and being a supporter of the team, from evaluating the company to playing a large role in value creation after it's a portfolio company. So you always have a choice of who you work with. I think the thing I would go back to is recommending founders to try to fill all of their investor slots with different roles. It doesn't so much matter what is that one investor going to deliver for you. It's in totality. Do you have all of the types of help that I mentioned about from that blog post, or it's on my LinkedIn right now? Do you have all of the different types of help that are represented across all the roles you need?
Going back to the blog post, you mentioned earlier about mental models, how you had one for chess and your decisions. Do you have other mental models for, future trends, for founders, for markets?
I do for founders, very much so. I was thinking markets at first. Some of the things I think about for markets, I tend to think of one of the classic mistakes VCs make is underestimating the size of an edge market. And what I mean by an edge market is a market that has the potential to grow due to a technology shift, which changes consumer behavior, but has not yet totally grown. And so that is an area where a lot of investors, like take Uber as the classic example. Everyone said the black cab car market is not that big, but that was the old market. The edge market that they were on the cusp of was ride sharing, which had not yet been invented. And once it was invented, it created massive consumer behavior change. I think that is a mental model I think about a lot. Another mental model about markets I think about, and this also ties to poker as well, is being sort of directionally correct with a broad thesis. The trick is not to necessarily know everything about the hand you're dealt per se. It's knowing which table to sit at in the first place, or said from a market's perspective, knowing which market to generally be focusing your attention on. I'll give you an example from earlier in my career when I worked in the VR industry. I used to work in 2016 at a VR company after Facebook bought Oculus in 2014. I thought this is the time, it's definitely here. And when I was working at the company, which ended up not being a success, it turns out it wasn't the right time for the application layer. The one good thing I got out of it was I looked around the ecosystem and I tried to ask myself, well, where is value accruing in the technology stack right now? And it became very clear it was accruing at the infrastructure layer in the GPUs. And so back in 2017, I ended up investing in NVIDIA. I really didn't have a lot of money to my name at all, but I put in a good amount of my small money. And that ended up obviously being like a great outcome for me almost 10 years later. But it wasn't because I knew that AI was going to come. It's just that I directionally understood when I looked around the ecosystem that the technology stack was accruing value to the infrastructure layer because of parallel processing from GPUs was a much faster, better, cheaper way to deliver a high fidelity computing experience than anything else that was on the market at that time. And so that's another kind of market mental model that I've written about and learned, or framework that I use, which is be pointed in the right direction and have a strong thesis about where value is accruing, even if you don't exactly get the specific application of it right. So that's on the market side. I also have a ton of mental models I use on the founder side and what I look for exactly in founders too.
If you want to share any of those, please go ahead. If not, I've already thought of the next question, but
let me share really quick on founders because this is one of my favorite topics to talk about. As you mentioned, I have a master's in education. I spent a lot of time thinking about how founders learn. My actual thesis when I did my master's was that very topic: how do founders learn? And so I have almost like a 7-point framework I look for when I'm looking for exceptional founders. I think one of the first things I look for is that they have extreme learning slope. I call them learning animals. These are people who use every single opportunity to extract as much information as possible out of that person and scenario. And they're able to pull advisors around them in their orbit that are way higher than they should be able to get because they're learning animals. I also look for people who are ruthless execution machines. They are able to execute like crazy. They're often urgently dissatisfied. They wanted everything done yesterday. And it's a little bit tragic almost how much they are upset by things. You ask them about product and they're like, here's the next few features I want to implement and why. And I just haven't had the resources or the ability to get them done. I have a founder like that in my portfolio right now who is so urgently dissatisfied about moderation. He wants to have put all his moderation features in place yesterday. This is for an AI companion company. And so that's another thing that I look for. Another thing I look for is people who are deep sector experts. They can go very deep in an area that is related to their company and really showcases their ability to get there. But at the same time, another thing I look for is that they're influential communicators. They can go broad, they can go wide, they have range, they're clairvoyant communicators. Their ability to discuss lots of different topics and persuade other people is really unparalleled. So those are a couple of the things that I look for in founders. And every single time I meet one, I'm like paying attention. I'm just trying to deconstruct how their brain works to see where they fall into some of these categories.
Now, going back to, well, actually, let's stick on that one more time. How about mental wellness as a founder? How Is that in any of the points there? How is that I don't want to say viewed, but when the person is so, I want this done yesterday, in the this is a healthy range to I want this done yesterday, okay, this is kind of crossing that.
You know, most founders probably have crossed it. They're a little, I would say, for the level of ambition that they're playing at, most of the founders I speak to do and work with do have mental health struggles at some point. And I think the really good ones understand how to bounce back from that and how to manage the up and downs, because they have to manage it if they are going to be in the marathon of building a company all the way to successful exit. The average exit used to be 7 to 10 years. Now it's taking more like 10 to 15 years for a VC backed company. That's an extremely long time to be running at full steam on your A game all the time. So I actually was discussing this topic with one of my founders last week, where she was really spending a lot of time prioritizing her mental health and making sure that actually it was really her body was healthy. And so, because she had kind of health issues pop up from basically being like chronically stressed and going full steam every day for months. So, and not sleeping, you would expect that. And so I think that's also our job as investors, is to just help give founders I don't want to say give them the permission, because obviously they can do whatever they want, but help them feel that the expectations of me as an investor is that they do maintain some balance, because I need them there for the marathon.
Now, you mentioned that these exits that used to take 7 or 10 years are now taking 10 to 15 or longer. It seems like some of the larger funds are pivoting towards becoming registered investment advisors, RIAs. How might that reshape the industry?
It's a great question. Yeah, and first, in terms of what funds becoming RIAs means. So, as funds are becoming RIAs, they're doing it really for more flexibility. Under the traditional VC exemption, where you register with the SEC, funds are limited in what assets they can hold. And as the lines begin to blur a bit between venture growth and other asset classes, even public markets, becoming an RIA allows these firms to invest across a lot of different types of assets. So secondaries, crypto, or crossover, publics. It is, as I think about the implications for a venture, one, why they're doing this is partially defensive. I think to retain importance and ability to hold on to these companies as they stay private longer and longer. To your point, you need to be able to move in and out of different types of holding structures for these companies. Also be able to buy secondary and from other investors and sell more secondary when they're not going public.
Mercedes, for our listeners, can you explain a little bit more what secondaries are?
Oh, yeah, sure. So secondaries are when you have the cap table of a company, the equity that they give out, there's primary and secondary. Primary is when you buy directly from the company and you're being issued and you're essentially buying some of their equity. Secondary is when you're buying equity from someone that is not the company's original equity. And so often you're buying from another investor. So for example, if a seed investor were to invest and own 10% of a company, say they bought it 5 years ago, OpenAI, let's say, somebody who was a seed investor of OpenAI, they put in some money at some low valuation, let's call it like sub 500 million. Today, OpenAI is rumored to be worth 300 billion. And who knows what the actual valuation is? I'm just saying what I saw in the reports. So if that's true, okay, so that seed investor, they've returned tons of money on the value of the markup of that investment, but it's not public yet. So they can't just liquidate their shares immediately. If they want to get any return, then someone else needs to buy their shares. You could have the company themselves buy it. That's like a buyback, but for private equity, it's a little different. Or you could have a new company come in, a new VC firm come in and buy it. And because companies like OpenAI don't need to be giving away more of their ownership to new investors, then it might make sense for them to facilitate some secondary transactions between investors so that they don't lose any of their additional ownership. So that's increasingly happening more and more. When you're a RIA exempt company, you can only use up to 20% of your funds as secondary purchases. And now when you're an RIA, you lift the 20% restriction. So now 100% if you wanted could be. That's probably not what anyone's going to do, but it could be that much. And so that's a massive increase in the amount of dollars that now can be purchased as secondary. It's essentially becoming the new IPO market, if you think about it, because that's the new liquidity that comes in the ecosystem for the earlier stage investors. And so when I think about that, I think the implications for the venture capital industry is that the life cycle looks very different. The exit is maybe no longer the IPO for the founders who can also sell some secondary of their own shares, or for the early seed stage investors. And so what does the IPO mean anymore? That's, I think, the real change that we have in the industry.
Question on that. I mean, it sounds like there'd be such differences between a registered investment advisor and a typical fund. I mean, a registered investment advisor might get paid 1%, whereas a fund, it might be 2% management, 20% carry. The fund has a certain lifespan, 7 to 10 years. The RIA, it's just managing the money. Doesn't that change the whole ecosystem of VC when you get rid of the time constraint and kind of the management success component of the fees?
Yeah, I think the question is, is venture really a wedge into a broader asset class business? If you think about it from a large kind of like holding company perspective, essentially you're looking at is the wedge and the cost of acquisition and all of the investments that you put into the venture capital business that returned 3 to 5x in 10 to 15 years, has a nice IRR somewhere in the 20 to 30% range. Is that the best wedge to then allow you to start to do a little bit different profile return things? What leverage and what unique special access does that give you? I think increasingly, because technology founders are what are making up the biggest market cap of all of the public companies. FANG, as we used to talk about, 5-10 years ago, is not going to be an exception. It's only going to continue with the next wave of AI companies. And the next wave of AI companies are not probably going to be the 1 to 2 trillion outcomes that the last cycle reached the peak of. They're probably going to be multi-trillions, maybe tens of trillions, hundreds of trillions, because they really change the margin profile and remove OpEx. And so if these much higher margin, much faster growing companies are going to be even bigger, then it starts to look really smart that, venture capital was a strong and good wedge into a broader asset class. And so even if you have to take lower fees on other parts of the business, I still think it ends up being a smart trade-off in the long term.
Now, are RIAs going to start playing poker then every day?
I'm pretty sure they're already playing poker every day. Oh, man. Do you play?
A little bit. I mean, we used to always have, it's been a while, but college Tuesday night was Texas Hold'em night. That's the rule.
Okay.
That was the rule.
All right. We'll have to play sometime.
Sounds good. And okay, so the RIA, it seems like a lot of the big VCs are switching into that. Do you think that maybe in the future, it's really, we might get rid of the whole VC class and it becomes venture studios and RIAs? And that's the whole kind of Silicon Valley ecosystem for startups? Or do you think there'll always be a place for VCs?
It's a good question. I think what is going to happen, and we're already starting to see this happen, is a separation of the market, where today I think there's 3 types of investors. There's really early pre-seed, seed stage investors. There's multi-stage investors that are not RIAs and that are not going for mega fund status. And then there's the mega funds. The mega funds are your Lightspeed, Sequoias, and Andreessens of the world. The pre-seed and seed funds, first rounds, well, they've actually gotten a little bigger too. But, companies like that, firms like that, I think what becomes harder is this middle ground company and firm that is a generalist, but is neither mega nor small. I think what you'll see most successfully for the middle size of VC firms are the ones who are sector specialists, because at least then, when they think about the seed pick when and portfolio support, the core roles that we do in venture, being a specialist allows you to win a lot better. I don't think it actually helps you see or pick better necessarily. I think there's the whole thing about how experts do not choose and pick better than novices, but it does help you win when the founder needs to decide, who am I going to choose? One of the roles that we talked about earlier, the 9 roles that a board or investor can play, is being a sector specialist. And so I do expect that will be the type of middle-sized fund that survives the best. But otherwise, to your question, to your point, I do think the bifurcation starts to become more extreme. I wouldn't say it's only venture studios or accelerators only, but I do think it will be people who are dedicated to the very earliest stages.
So then for people looking to enter and cross over into VC, what recommendations would you offer them in mindset, timing, relationship building, where to look, where to go? What would be your guidance?
Okay. So my top advice generally for young people, this is not necessarily anyone getting into VC, but generally for earlier career people, is today, increasingly, AI can do a lot of entry level jobs, especially in white collar and in knowledge work. It just can. And so if you're going to stand out, your best defensibility is to know how to use AI tools better than anyone else. So if I was in college, if I was early career, 20 through 27, 28, I would be spending all my time building agents, automating all of my tasks, and figuring out how to be extremely AI native, use voice detection, voice to text to image, text to video. How do I build a presentation at high accuracy like this? And that is what will keep you afloat and honestly being value add to the firms where they're trying to incorporate AI, but they don't have it yet. And then more specifically for my advice for getting into venture capital, I think the best thing you can do is start doing the job you want to have. When I was getting into venture back in 2018, I didn't have money to angel invest. As I mentioned, I had very little money to my name. I had only just invested in NVIDIA the year prior, and I had basically no liquid money. So what I did was I went and said, here's what I would invest in. I wrote down all my theses. I had 3 thesis areas: education, virtual reality, and multicultural consumer products were the 3 at the time. And then I wrote sub-theses about each of them. I first wrote out and pulled a lot of data on why these were interesting categories. Then what are the current trends and areas of opportunity within each of these themes? And then what are the specific companies that I felt were interesting? And I went out and I did the diligence. I met founders, I interviewed customers, I interviewed employees, and I wrote memos about if I was an investor, what I would invest in. It was kind of ridiculous to do because I had no money, but I was kind of like just trying to go through the motions and say, this is how I would do it. And then I would go to venture capitalists and I would say, here's what I think I would invest in if I were at your firm. What's your feedback on this? What do you think? And it turns out when I had been going back and forth with Lightspeed back in 2018 and shared some of this with them, that one of the companies I suggested was one they had actually been given a term sheet to just a couple of weeks prior. And I had no idea. And so that made me look like a genius because I was putting together all this work. And I had actually a lot of industry insight about that company because I had worked in the category as a startup operator before and as a founder. And so that was very serendipitous. But the point being, if you start putting yourself in the shoes of the person on the other side of the table doing the work, they're going to think, I don't have to train this person this much. This person already gets it. They understand exactly what I'm looking for. And look at their hustle. I remember them saying to me, because I didn't just put together a memo for one company in that thesis, I put together multiple memos for every single sub theme opportunity of companies across seed, Series A, Series B, and growth, and even a buyout company, because I wanted to prove and show that I had range and I could think about growth stage and buyout investing as well as pre product. And so, anyway, that I think was a really successful process for me. And if you can get people to give you the time of day to show them that, then that I think will really result in good things.
All right. Before wrapping it up, you'd mentioned earlier a mentor that gave you some advice about the actual input from the founders and the board for the success. What are some other impactful lessons you've learned from mentors throughout your careers in tech and investing?
Oh, so many good things. Well, Jeremy Liu, who he was the seed investor in Snapchat, that was one I referenced earlier. One of the things he taught me is the four things that he looks for in a consumer investment: that it has a scalable, repeatable way to grow, evidence that it's creating a habit for its customers, that the founder has unique insights about why it's working and understands why it's working, and that they are building on the back of a cultural tailwind or a cultural movement, because that gives the company liftoff ability. So that was really good training there. Another thing I learned from one of my mentors, Gretchen Clayton, when I was at Goldman Sachs, I'll never forget my first few days there. I was working on some presentations, printed it out, and she said, "Come over with me to the side conference room." And I was like, "Oh no." And she had printed out the presentation I had sent her, and there were just red marks everywhere. And she was like, "You missed a space here. You had an extra zero here. You had a dot here. You had a like quotation, like," and just all the little attention to detail things that I had messed up. And that was the best lesson in how to never lose attention to detail. I mean, I was a young person. I was 21 years old, so I didn't have it yet. But Goldman, one of the things they really prioritize is extremely high throughput with high efficiency and zero mistakes. And so that really taught me a lot in that setting. So those are some of them. And then also, I remember the founders of General Assembly, also where I worked, Jake and Brad and Matt and Adam, they were the founders of that. One of the sayings that actually Brad used to say was all about making things faster, better, cheaper for our customers. And he said, every time you add an extra piece of friction to the sign up process, a small, cute baby kitten somewhere dies. And it was like a very weird saying, but it was so striking in your mind that you remembered, like, don't add friction. Don't add friction if you don't need to. And so that was another great lesson that I learned as well.
Fantastic. And Mercedes, if anyone wants to find out more information about you, your blog, what's the best way to go about doing it?
Find me on LinkedIn. I'm publishing a lot of content there, Mercedes Bent, and also on my website, mercedesbent.com or mercedesbent.co.
Fantastic. We'll have those links in the show notes. And for our audience out there, when I'm not the host of the Silicon Valley podcast, I'm an investment banker focused on mergers, acquisitions, and growth capital. Connect with me on LinkedIn or go to svhcapital.com. But to find out more about the archives and our show notes and all our past guests, go to thesiliconvalleypodcast.com. And with that, Mercedes, thank you for taking the time to be on this week's episode of the Silicon Valley Podcast.
Thanks so much, Sean.